Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of LME 3-month nickel and zinc. I'll start with LME 3-month nickel. The core pattern that has driven this market since mid-July has been the July to November ascending triangle. I've once again highlighted a pattern in dark blue on my daily chart to aid in visualizing it. Whilst this looks like a good pattern, it has, for example, had the requisite number of touches on each side that is necessary, it still had some imperfections. Both the lower trend line and the flat overhead trend line had been breached, most recently the upper trend line. However, the breaches were repaired, and in the end of it had been a good pattern. It's noteworthy to mention that the overhead flat trend line is also the August 2011 high, and it had in the past been reinforced by the nearby long moving average, currently at 26090. In mid-November, the market broke up through the flat overhead trend line, punching and closing over both this trend line and the long moving average. We then saw the exploitation of this move higher, with prices pushing up through and closing over the May 2011 high at 27330, the April 2011 high at 27950, the recent 50% Fibonacci line at 29470, and 2 weeks ago reaching up to breach the 50% Fibonacci line of the March 2020 to March 22 move at 32945. Previously, I'd given the potential size of the move higher from this ascending triangle pattern and labelled some detailed topside targets. Thus, we had a primary target in the 30070 area and a secondary harder to achieve target X in the 32160. The primary target was achieved back in November, and 2 weeks ago the market reached the secondary harder to get target X in the 32160 area, which is kind of satisfying. There is one other factor I'd like to revisit. I said 5 weeks ago, and I quote, "We had another bullish factor late 2 weeks ago." Well, that is now 7 weeks ago. It was a bullish bow tie formation of the short moving average, currently at 28075, the short medium moving average, currently 25270, and the medium moving average, currently 24,000. They all crossed over 2 Fridays ago, so this is now 7 Fridays ago. Now, bow tie formations have 2 elements. First is that the market moves in the direction of the exiting moving averages from the bow tie crossover. In this case, it was upward, and that proved to be the case. The second is that between the 15 to 20 sessions after the crossover, in this case it would be between the 25th of November and the 2nd of December, we ought to see the beginnings of the next major move, and it usually in the direction of the moving averages, or upwards as well. Thus, I would ask you to look out between those dates, especially to gauge what is happening." End of quote. Well, we can easily see that the market continued its bullishness and peaked out a few days after the end of the window on the 8th of December. Yet in this peak were actually the seeds of its demise, as the session, despite the highest market since April, ended up as a combined bearish dark cloud cover pattern, bearish closing black Mariboso, and a possible, now I stress possible, as some purists will not agree, but a possible shooting star pattern, type 1 bearish. Interestingly, in all that activity, the market only made the one single close over the recent 50% Fibonacci line at 29470, despite breaching it a number of times. Prices have since dropped down below the April 2011 high at 27950, and yesterday below the May 2011 high at 27330. The next support, before we run into the ascending triangle pattern itself, is actually reasonable support. It is a slowly rising long moving average, currently at 26085. And avoidance of testing of this possibly formidable support that we have seen recently have seen prices move higher today. However, the rise has been capped by the 50% Fibonacci line at 29470. Thus, I suspect we may, for the moment, be capped by this 50% Fibonacci line and supported by the slowly rising long moving average. I would have to add that right now it seems more likely to see a test and possible break of the 50% Fibonacci line topside than a combination of the long moving average below plus the remnants of the ascending triangle that is also below. LME 3-month zinc. There is a hell of a lot going on here, which just about describes all the multicolored trend lines and patterns it's seen here. Back in November, the market broke down through the lower tine, currently 28.42, and highlighted in bright red the big old 2015 to 2020 bullish Andrews pitchfork. However, this was repaired within a week, and it continues to hold up the market along with the congestion between 27.91 and 28.25, which included the June 2021 low at 28.10, the July 2021 low at 29.06, and the August 2021 low at 29.17. All these played their role in supporting the lower tine and the market. At the end of November, prices pushed up over the middle tine, currently 29.91, which is highlighted here in purple, and that's of the more recent late May to mid-August bearish shift pitchfork. Then they started using it as a base to push up over the flatlining medium moving average above, currently at 31.22. Once properly over this medium moving average 2 weeks ago, prices punched up over the June 2018 high at 32.20, and last week over the April 2018 high at 33.02. However, by the middle of last week, prices had reached up to the 50% Fibonacci line of the March 2020 to March 2022 move at 33.29, breaching it but failing to close over it. Now, one could say that it was the 50% Fibonacci line that ended the run up and eventually caused the market to turn down into a weekly key reversal down for that week. However, I would rather say the following. Yes, the 50% Fibonacci line may have stopped the market rise, but the threat of the declining long moving average above, currently at 34.06, well, that turned the market down. Prices dropped down through all the previously listed supports at 32.20 and a flatlining medium moving average until last Friday. They dropped and hit the combination of the middle tine of the shallowly bearish recent late May to mid-August bearish shift pitchfork and the flatlining short medium moving average, where we have halted. So what has this left us with? Well, firstly, I spoke last time about the action since mid-September to date looking like a possible reverse head and shoulders bottom with the neckline at the 32.01 area. This seemed to open up all sorts of possibilities, but the declining long moving average took care of that idea. Next, we have something I've spoken about a lot. It is the March 2020 to June 2022 expanding wedge pattern, currently at 39.27. And the top side of it is the lower trend lines at that, and the upper trend line is way off the top of my daily chart. This pattern is highlighted in dark blue in the upper part of my daily chart. There are some outlandish potential targets for such a long-dated and wide pattern. So, to keep an element of realism in here, I would suggest only looking at just the possible primary target X for such a pattern, and that's in the 25.45 zone below. This is one for the back of the diary and to be reviewed maybe once a year or so. However, the failure of the rally from the nascent reverse head and shoulders has seemingly put paid to that idea for the head and shoulders for now. Thus, it leaves a shallowy bearish recent late May to mid-August bearish shift pitchfork. The middle time was somehow has managed to hold the market up. Well, I'd suggest to keep a closer eye on that one. I'd suggest watching further to see if there is more to this, as it holds interesting opportunities. It is, after all, the middle tine, a support right now in what is a gently sloping bearish market. And until something else shows up, it may be the most interesting thing to watch. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.